Hello everyone. The purpose of this video is to give you a brief on paper financial management in the ACCA qualification. So basically, this is one of the papers that I teach on this professional qualification. Now, to break it down, and for those of you who are a little bit familiar with finance, you will recall this equation here: assets equal equity plus liabilities. Now, you'll be amazed to know that whatever we do in financial management, well, it kind of goes or surrounds that equation. This is because there are only two ways of raising finance in a business. There are only two ways. Either it's through equity. By equity, we probably mean issuing shares, or liabilities. Now, what I'm going to do, I will try to change this word liabilities for now and put debt in there. So either there are only two ways of raising finance in a business, either through equity and debt. So I've put this here. This is how we raise finance. There are only two ways, equity and debt. Now, what do we do once we've raised the finance? Well, surely it must be put to some use, isn't it? So once we raise the finance, we would apply the finance or we would invest it in assets. Now, when it comes to assets, probably we will decide whether to buy a new piece of equipment or machinery, etc., or we will invest in working capital management. So probably you're buying inventories or anything of that nature. Now, before you make any decision whether it is worthwhile to invest or not, we have to decide whether this is bringing value to the equity shareholders, because let's remember the one who owns the business are the shareholders. So everything you do in F9, you have to be adding value to the shareholders. Now, this is a key decision whether whatever we are doing as a finance manager, whether it adds value to the shareholders, which is why the key topic area in financial management is investment appraisal. Investment appraisal simply gives you tools to decide whether it is worthwhile to invest in maybe a piece of equipment or not. Now remember, once you have raised finance, it can also be used through working capital. So working capital, things like inventory, receivables, cash management, and also payables. In that aspect, the second major topic would be working capital management. The third topic area, so in order of priority, when we raise equity and we raise debt, so surely if a shareholder invests in a business, that shareholder would not invest unless they get some form of return. Now, that return for the shareholder, think about it, it is a cost for the company. So whatever return, let's say you have to guarantee a return of 10% to the equity shareholders, it is a cost to the company because every year we have to give back 10% to the equity owners. And same goes for debt. Debt financing. Let's keep it simple. Imagine you've taken out a loan from a banking institution. Now, surely any loan does not come free of charge. The bank will charge some form of interest. So, whatever you have to pay the bank, in this case, the interest, that will be a cost of debt. So, surely here you will conclude that there is a cost of equity and there is also a cost of debt. And one of the principal calculation that you have to do in F9 is, well, what exactly is the cost of equity and what exactly is the cost of debt and what is the cost as a whole for this company? And because we use a combination of equity and debt, the cost would be an average of these two. So it will be an average cost of equity and average cost of debt. In this instance, we will have to calculate the cost of capital, or what is commonly known as the weighted average cost of capital, or the WACC. Then you would move on to look at business finance. So whether you go for maybe short-term financing or long-term financing in the business. So maybe bank overdraft or a long-term loan, and what are the benefits or drawbacks of using those. Another key area, once you've you know, kind of covered all that aspect, it is important to value the business. So think about if you want to sell your business and someone is willing to pay a price for this business, how would that be determined? So we would be valuing the whole of this business. So that's another important topic area, that's business valuation. Finally, you would be dealing with risk, but when it comes to financial management, most of the risk that we will be talking through is foreign exchange rate risk and interest rate risk. There you go. This is a short introduction of what you can expect in paper F9 Financial Management, and I hope this video is helpful.